This is Form 1120S, the informational tax return for an S corporation. Missing the March deadline for this document triggers a rigid sequence of automated penalties. Many business owners assume that if their company owes zero actual income tax, filing this document late carries no consequences. Code 6698 and 6699 set a fixed penalty of $255 monthly per partner. For a company with 3 partners, that is $765 every month. This simple administrative oversight can scale into thousands of dollars in penalties over a year. Faced with these numbers, many business owners pay the invoice immediately out of fear, assuming the government is an inflexible entity that does not negotiate. Blindly paying that penalty sacrifices business capital that can often be legally preserved by utilizing specific administrative safety nets. A very common mistake is dropping a tax return in a standard mailbox on the evening of the deadline. Taxpayers often rely on Code Section 7502, the timely mailing treated as timely filing rule. This statute protects you if your return is postmarked on or before the due date. However, standard mail postmarks are frequently applied by automated sorting machines at a regional facility. This often happens a day or two after you drop the envelope off, making the return legally late. Relying on a standard mailbox trades a few minutes of convenience for total exposure to compounding financial penalties. To secure the filing date, you must use USPS certified mail or an IRS-approved private delivery service, such as FedEx Priority Overnight. Spending the extra money for a certified receipt provides you with a legally binding, date-stamped document. This serves as your defense if the IRS later claims the return arrived late. This grid shows that you must also mail to the correct service center. If your business location and asset size map to the Ogden facility, sending it to Kansas City can cause further processing delays. If the return isn't ready by mid-March, your best preventative measure is filing Form 7004 to request an automatic 6-month extension. It is critical to distinguish that an extension prevents the $255 per month late filing penalty, but it does not extend the time required to pay any taxes the business actually owes. Utilizing certified mail or extensions shifts the burden of proof off the taxpayer, legally overriding the IRS's automated penalty systems. The scenario changes for those who realize they missed the deadline entirely, without an extension or a certified receipt. Your remedy is an administrative waiver called First Time Abate. This is an IRS policy that allows agents to remove certain penalties over the phone for a first offense. Eligibility is based on your record. The business must have filed correctly and maintained a clean penalty history for 3 previous tax years. When met, the IRS can remove massive failure to file or failure to pay penalties, regardless of the dollar amount. However, avoid the unpaid tax trap. If your tax balance is still outstanding when you request this waiver, the penalty is only removed up to that day. It will start accruing again immediately the next morning. First Time Abate is a limited resource. Once used, you must maintain another 3 years of perfect compliance before the business becomes eligible for the waiver again. For those who meet the history requirements, this is the most effective phone call a business owner can make, as it converts an expensive mistake into a simple warning. If your business has a history of penalties from the last 3 years, you will not qualify for an automatic first-time abate waiver.
In this case, your remaining legal option is filing Form 843 to request penalty relief based on reasonable cause. Unlike the objective requirements for first-time abate, reasonable cause is subjective. You must prove that extraordinary circumstances, not just a simple mistake, prevented you from filing on time. Relying on this path places your request entirely at the discretion of an individual IRS agent, whose judgment is far less predictable than the clear rules of the first-time waiver. You must map your specific actions to the correct legal defense to resolve the penalty efficiently. If you mailed on time and have a certified receipt, your defense is Code Section 7502. You should use this statute to dispute the penalty, so you do not use up your one-time first-time abate waiver unnecessarily. If the deadline was missed entirely but you have a 3-year clean history, you call the IRS and request first-time abate. For those who genuinely forgot the date, using this waiver is the fastest way to stop the compounding interest. If your record prevents an automatic waiver, you are left with a manual request for reasonable cause, a difficult position that carries no guarantee of approval. To avoid this situation in the future, Implement systemic changes, such as the Profit First methodology or mandatory tax extensions, to ensure filings are handled long before the deadline. Establishing these systems creates operational calm during tax season, replacing the frantic last-minute rush with a predictable process. Managing IRS deadlines isn't about perfect accounting, but about strategically using the rules to turn administrative hurdles into a manageable part of your business.